Global stocks wobble as Ukraine conflict fears escalate. British inflation is hotter than expected. China's banks hold lending rates amid a focus on fiscal stimulus. And Bank Indonesia says post-Trump currency moves have affected its ability to cut rates. That's coming up in our 5 Things in 5 Minutes. And then in our bonus deep dive interview, ANZ senior rate strategist Jennifer Kusuma looks at the implications of Donald Trump's win for Asian local currency bond yields.
The hurdle for central banks in the region to cut rates has now risen since market participants are expecting an upgrade in the US growth inflation outlook. And secondly, appetite for Asia local currency bonds has also weakened.
But first, in 5 and 5 with ANZ, the S&P 500 and Nasdaq are down almost 1% at 4 a.m. Sydney Melbourne time as market volatility increases, along with fears the Ukraine-Russia conflict is escalating. Ukraine fired British-made Storm Shadow missiles into Russia for the first time overnight, and Joe Biden authorised the use of US-made anti-personnel mines against Russian troops for the first time. Meanwhile, British inflation data overnight showed prices rose 2.3% in October from a year ago, above the 1.7% seen in September and faster than the 2.2% consensus. Here's ANZ economist Bansi Madhavani from London overnight.
The October inflation data warrants the Bank of England taking more time. We think the Bank of England is unlikely to cut rates in its upcoming meeting in December, and further progress on inflation is required for them to be able to cut going forward. That reflects pretty much in market pricing as well, given that markets are now pricing odds of a December rate cut just under 10%.
The US dollar index was up 0.6% at 4 a.m. as traders looked for safe havens. US Treasury yields were up a point or two. The Aussie dollar down 0.6% on that stronger US dollar at 64.92 US cents. And the Kiwi was down 0.7% at 58.69 US cents. Number 2, China's banks held their key 1- and 5-year lending rates steady this month, as expected. ANZ senior China strategist Zhao Pengxing says one reason was the growth outlook improving in recent months. But banks are also reluctant to reduce rates following the announcement of a large local government debt swap program, which threatens the profit outlook for China's commercial banks.
China is trying to replace the implicit debts of local governments by the local government special bonds. I think this program will hurt the profit outlook of commercial banks because it replaces the high yield implicit debt with low yield local government bonds. The commercial banks will have to lose a lot of profit in the future. So against this backdrop, I think the Chinese banks will have no interest to cut LPR again in the near term.
Number 3. Zhao Peng says ANZ research still expects the loan prime rates, or LPRs, to be cut through next year.
I think we still have a good chance to see a cut to LPR, especially the 5-year LPR, because it's related to the mortgage rate. At this moment, the mortgage rate is still too high compared with the housing rental yield. I think next year we have 30 bips call for the policy rate cut and 30 bips call for the LPR 1 year as well.
Number 4. Bank Indonesia held rates at 6% yesterday, with the central bank governor warning that the previous scope for rate cuts has narrowed after recent currency depreciation. ANZ economist Crystal Tan says that's down to the strong US dollar after the election of Trump.
Given the recent rise in geopolitical and global uncertainties, especially US political developments that have pushed up the US Treasury yield and the US dollar, rupiah stability is currently the priority for BI. So it's notable that BI now anticipates a shallower US Fed easing cycle than before. Now, in terms of guidance, BI did retain an easing bias, but it also acknowledged that the scope for rate cuts has become more limited. The rupiah trajectory is going to be a key factor the bank monitors as it gauges the scope for further policy rate cuts.
Number 5. Japan's exports resumed their growth in October by more than expected, rising 3.1% from a year ago after slipping in September. ANZ FX analyst Felix Ryan says that's positive for fourth quarter GDP growth after net exports were a drag in the third quarter.
In terms of concerns, look, there is still that worry about the impact of any potential tariffs from the incoming US administration on global growth and global trade. And even before any of those tariffs, we have seen for some time some of those global headwinds show up in that trade balance data for Japan. So looking at some of the details in terms of exports to various regions, in October we saw exports to the US down 6.2% year over year. To the European Union, it was down 11.3% year over year. So not exactly positive news there. In terms of China, though, we did see a 1.5% year over year lift in terms of exports from Japan to China.
Felix Ryan there. Now, for our bonus deep dive interview, ANZ senior rate strategist Jennifer Kusuma analyses how Donald Trump's win may put a floor under Asian local currency bond yields.
Trump's win and the Republican sweep have drawn a floor under bond yields in our view. The risks are now skewed to the upside. We can see two transmission channels for Asia local markets. Firstly, the hurdle for central banks in the region to cut rates has now risen since market participants are expecting an upgrade in the US growth inflation outlook. And secondly, appetite for Asia local currency bonds has also weakened given the uncertainty around US tariffs. So I would expect participants to likely stay sidelined until we can assess the policy details and implications.
Do you have a sense of how much of a move we could see or how much has already happened?
Well, the US Treasury yields have risen by a good 30 to 60 basis points since troughing at the end of September. So we may not see the kind of magnitude going forward, but still a speedy and an aggressive implementations of Trump's tax and spending plans that could still open upside risks around US Treasury yields, maybe another 15 up to another 40 basis points.
What might Asia local currency bonds, why might they be better anchored than their US dollar counterparts?
So on the domestic front or on the local currency front, the economic growth and inflation dynamics, they are relatively well contained. Fiscal spending in the region is also quite conservative. So there are no obvious imbalances in the financial system in the region. So this has justified the lower interest rate spread versus the US dollar in the historical, especially compared to in the historical context. And also some markets like India, like South Korea, they are seeing a structural increase in their bond investor base, not least because of the ongoing global bond index inclusion. All these factors considered, we expect even if US Treasury yields continue to rise from here, most of the low-yielding local currency bond markets as well as India, they should continue trading with a lower beta to the US Treasury. What this means is that in a rising rates environment, these bonds should not be sold off as much as the US Treasury counterpart, as we have also seen as has been the case in the last 1.5 months.
So what sort of information do people want to see to know more about the future for local currency yields and I suppose yields globally?
So from Asia's perspective, a backdrop of dollar strength and rising real interest rates, that would be challenging for Asia local markets because currently US dollar is still a higher yielding currency relative to many of our Asian currencies. So what we need to know is firstly, really the outlook for the Fed funds rate path, how this will be impacted by Trump's in the near term, most immediately, their tax and spending policies. And secondly, of course, tariffs on Asian exports that would determine how economies in the region perform going forward.
Jennifer Kusuma there. I'm Bernard Hickey. That was 5 and 5 with ANZ for Thursday, November the 21st. Catch you tomorrow with what the state of the US jobs market might mean for the Fed's rate cuts. This podcast contains general information only, not investment advice. You should obtain advice for your personal circumstances before making any investment decisions. Please view the podcast disclaimer available via your media player or email.